We had a class this
Okay, 2 chapters today. First, we're going to do 11, and then we're going to do 12.
Well, it's going to take you a while to get through.
So first, we're just going to focus on chapter 11 here, and we're going to just focus on the other credits.
Which, like I told you, the IRS doesn't even.
So we're going to talk about some of the more obscure tax credits, except for the first one. Premium tax credit has to do with health insurance through the marketplace. And so we're going to discuss what that actually means a little bit. We're going to talk about other tax credits that are on Schedule 3. But some of the reasons why we're not doing this why it's just kind of off like this in a rapid fire, these aren't very popular credits. In fact, some of these you might not use for years. And in fact, some of them I almost didn't want to talk about because with the incoming administration, some of these are energy credits. We already know that some people coming in aren't so keen on green energy and such, so they might want to get rid of these. Again, we're going to talk about refundable and non-refundable credits. All right, so this is basically the only refundable credit I think that we're going to talk about today is the premium tax credit and the advanced premium tax credit. So they call that a PTC. It's a refundable credit designed to help eligible or low or moderate income individuals and families to afford health insurance through the health insurance marketplace. If that continues to survive. In general, you're eligible for this premium tax credit if you're not eligible for Medicaid, employer-sponsored insurance, or other acceptable coverage. That's kind of up to you. I mean, you can make that decision whether or not you want to buy your insurance through the marketplace. I'm not aware of any actual restriction about even if you're covered by work that you just can't decide, well, I don't like the work plan. I'd rather have it through the marketplace because it might be better. When you enroll, the marketplace will estimate the amount of premium tax credit you will be allowed for the following year. This is the problem with the whole thing. This estimate is based upon your estimated household income for the year. You then can choose to have all or some of this estimated premium tax credit advanced directly to the insurance company on your behalf. These are advanced credit payments. Okay, so what you've got here is a couple of problems. Low or moderate income can't afford it by themselves. The government helps them buy insurance through the marketplace. They give them a subsidy, a tax credit. In this case, they call it a tax credit. It's handled through the tax form. Nothing to do with tax. It's not a tax.
Separate. Right. Okay, don't worry about it. All right.
But like I said, it's handled through the forms. You get a assistance in payment based on your income for the year. The problem with the whole system is that we're basing, you're going to buy next year's insurance. So enrollment period, I think, is open for 2 more days. So I can go down and I can sign up for insurance through the marketplace. And they're going to take a look this late. They're going to take a look at most likely my last paycheck stubs at this point.
Not right now anyway.
And decide where we are on the income scale for the year. And then say, okay, this is basically going to be what we're going to base it off of for next year. And we're going to give you we're going to give you payment assistance based on your adjusted gross income for next year. But we're guessing what next year's income is. You have no idea. You get a raise, you get a bonus. That could screw you over big time. Because all of a sudden now I'm getting more assistance than I should for my income level. And so if that happens, I have to pay it back. And how do I pay that back? On the tax form. The inverse is also true. I get fired. My income goes down. Now I'm not getting enough assistance And so I get underpaid.
And,
How did they fix that? On my tax form next year, it'll become part of a refund, a refundable credit.
Here's her social.
So that's that in a nutshell. You sign up for the health insurance marketplace, they're gonna assist you in paying based off of numbers that really aren't necessarily valid. It is your responsibility to pay attention throughout the year to figure out if that number is in the right ballpark. Because if you're, especially if you're going way over, I'm making a lot more money than I did last year. You're gonna have a problem. You're gonna owe at the end of the year. And it could be big. There's one person, the worst I've seen, she owed over 10 grand. Because she got an assistant. And here's what happened. It was her own, it was kind of her own fault. She didn't think about it. Again, it's one of the things. You do it, you don't think about it. People don't necessarily think about all these rules and what happens to them. They don't even understand the rules. She was retired, but she wasn't on Medicare yet. So she was buying some supplemental insurance through the marketplace. And they, okay, fixed income, she should be good. Not really gonna change. She's retired. Payment's gonna be equal all the time. Well, she decided she was gonna buy a car, so she took out a big withdrawal, which then bumped up her income, which then made assistance values invalid. And in fact, it bumped up her income so much that for the entire year, she shouldn't have gotten any assistance. So every dime that she got in assistance to pay for medical insurance, she had to pay back. That's why she owed over 10 grand. That's the problem with this system. I mean, I realized that we had to do it someplace. We had to start somewhere. We had to figure it out somehow. That's just where it came from. So if you're on the marketplace, you need to pay attention to your income throughout the year.
No, wait a minute. Let me ask you this. You're saying that you
Also, if you're on the marketplace, you have a filing requirement. I don't care if you don't have any income whatsoever. If you have no income, and you're on the marketplace, you have to file a tax return. This is the form that the marketplace sends out to the taxpayer that's on the marketplace to make sure. On this form is good stuff, the taxpayer's name, spouse, if they're married, if they're also insured, dependents that might be insured. All of that appear here, but what we're really worried about on this 1095A is this information down here. Because in here is going to be what the monthly premium was, what the taxpayer paid in health insurance, and what the government helped pay in health insurance. Everybody has this problem.
And then you can
By month. Because some people, hey, they only got for the first 3 months of the year because they forgot to cancel it. This is where we have some of our problems. Is we'll file a tax return and they'll reject because they show that they get a 1095A and the client didn't put it in, so we didn't put it in. Well, I didn't have health insurance in the marketplace last year. Well, did you have it for the year before? Well, yeah, but that was the year before. Well, this is true. Did you officially cancel it? Well, no. Then you probably had 3 months because of COBRA of health insurance. And that's what happened. That happened at least 10 times last year for us. It might have been more. I might be conservative on that. But we need to do this to find out whether or not they got enough subsidy or too much subsidy. And this is the form that helps us do that. So we take this 1095A and we put it into the computer, and the computer feeds this form, the 8962. And actually, when I get a rejection because of health insurance marketplace, it tells me that it needed an 8962. But that tells, I already know, I need a 1095A. Let me try this.
I know we have.
Check on this printer here real quick.
I'll have to find information for you. I can email that information to you. I'll email it. I'll email you that information, and then you can contact them if they help with that.
There's the rest of your book.
Right, that would be what.
That's fine. All the
Okay.
teaching classes
So the premium tax credit is calculated on your tax return based on your actual reported household income, as we talked about. Advanced premiums, though, were calculated based on your household income as estimated, and as estimated is basically, they look at last year's taxes, where they look at, since the enrollment period is only through October through December, they're looking at your last paycheck stubs. But it's still last year's taxes.
Yes.
They're basing off old information. If you received any advanced tax credit premiums or wish to claim the PTC, you must file an E-962. Well, you have to. I mean, there's no option. The amount of the premium tax credit allowed is reduced, but not below zero by the amount of any advance payments. If the advance payments for a taxable year exceed the allowed premium tax credit for that year, will be increased by such excess. In other words, if the advance payments are greater than the actual premium tax credit, you must pay back the excess. You got too much subsidy, you gotta pay it back. And it's handled on your tax
I
return.
have to say one.
If the advance premiums exceed the premium tax credit, such excesses will appear on 8962 line 29. You'll get a refund, or at least you'll get a refundable tax credit. No, based on other problems, you might not get a refund because you paid other taxes with it, but at least you had a tax credit. And most of the time, you're probably gonna get a refund. So continuing on, we're gonna focus in on some things on Schedule 3. And most of what we're gonna talk about that's left over is non-refundable credits. And we've talked about some of these things, like line 2 up here. We talked about care for dependent care credit yesterday, and that's line 2. Education credits, we talked about that yesterday, that's line 3. So, and then we're not gonna talk about all of these. So let's hit some of the highlights. Foreign tax credit, Form 1116. If you pay foreign taxes to a foreign country or foreign source income and are subject to United States tax on the same income, you may be able to take this credit. Generally, if you pay taxes to both U.S. and a foreign country, this credit should reduce the total of these taxes to a greater of the two tax liabilities. Therefore, you will not be double taxed. The government's actually being generous here. They don't have to do this, but they do. So let's talk about this in some aspect of it. Okay, so like Canadians, obviously they have foreign income. They live and work in Canada. They get paid in Canadian dollars. They get paid in Canadian income. They pay Canadian taxes. What they pay in Canadian taxes, I put on their 1116 as a tax credit. Spoiler alert, Canadian taxes are higher, so my clients never have to pay U.S. taxes because their tax credit takes care of all their U.S. tax liability.
We have one, we have one. Liberty enforcement. I just have to find it. And as soon as I find that, it'll be.
No. I want you to expound on that.
I didn't expect anything this morning.
Well, yeah.
Well, he can get that answer.
Oh, the Alaska permanent friend, is that what you're referring to? That's not a tax credit, that's actually income. Yeah. No, but that's state income from the state of Alaska. So when I'm talking about foreign income on foreign taxes on foreign income. Okay, so my Canadian, my clients in the United Arab Emirates don't get this because they're not taxed. They don't pay taxes to the UAE, so they don't qualify for this credit. Only right now is my Canadians. And let's not overlook the fact that this is to foreign governments. So not only do I count the amount of the money they pay to on income tax. Remember, income tax. No other taxes, income tax. But I get to count what they pay to the government of Canada in income tax, and I get to count what they pay to the province of British Columbia in income
So if you owe
tax.
state, it's gonna kick into.
I don't know if I'm-
So I add those two together. I put that form on. I put that on the 1116 as foreign taxes paid. Now, like I said, it has to be
Right.
taxes based on income. Now, Canada also has Social Security tax. Well, they call it something else, but Social Security tax. They also pay their unemployment tax or unemployment insurance taxes. Okay, those don't count for this credit.
No, you're fine, you're fine.
Also, I'll point this out in a webinar I took a few years ago. I don't think the rules have changed. They might have, but say for instance, France, they have a tax, but it's not eligible for this form because it's not based on income. It's based on net worth, and that's not in the scope of this tax credit.
Thank you.
Nor is it in the scope of the foreign taxes paid deduction that's on Schedule A. I talked about that on Schedule A day, and you have a choice. You could put it there, you could put it here, but you can't use it twice. This is what it looks like. And it is set up for you to be able to do multiple countries. Now, and I frame this in the reference of my Canadians because it's easiest to put around. But even just Joe Blow could have foreign income tax paid if they have investments in foreign companies and they get a dividend distribution. This is how it happens most of the time. They get a dividend distribution from a foreign company. They might, and that's probably going to be in the focus is that they own shares in a mutual fund that is focused on overseas investing. And so they'll get a 1099 DIV back from the investment company for income that the dividends they receive from these foreign companies. Yeah, thank God it's already converted into US dollars, but they pay taxes to these foreign countries based on that dividend income. So therefore, when I fill out my 1099 DIV, one of the boxes on there is foreign taxes paid, and it's going to feed this form.
Because they treat it as a bank.
And then I will turn around and say that although there's a little box, spoiler alert, pro tip, when you're filling out 1099 DIV and you have foreign taxes, I do not need to fill out this form if my foreign taxes paid are less than $300. And there's a little box to check saying that my foreign taxes paid are less than $300. I don't need 1116 that just give you just carry the credit forward because the IRS has a copy. They know. They got the copy of the 1099 DIV. They know. Retirement savings contribution credit. Not the greatest credit in the world. You may be able to take the credit if you or your spouse have finally jointly made contributions other than rollover contributions to an IRA or qualified plan. However, you cannot take this credit if your adjusted gross income exceeded $73,000 for married filing jointly, $54,750 if head of the household, and $36,500 if married filing separately, single or qualified surviving spouse. We did that. Cannot take this credit if the person who was making the contribution was born after January 1st of 2006, is claimed as a dependent on someone else's return, or was a full-time student at any 5 calendar months during the taxable year. All right, so we're looking at this, and the down and dirty about the credit when you're looking at this is that it's an additional credit for putting into it, contributing to an IRA, contributing to a retirement savings account anyplace. But it's geared toward lower income people to encourage them to set aside. Because these aren't big numbers. And then they turn around and say, okay, this is geared at young people. Well, sorry, your income's probably gonna be low that you'd qualify, but we're not gonna let you do it if you're not 18. We're not gonna let you do it if you're being claimed as a dependent, which at least that rule is consistent. And we're not gonna let you do it if you're a student, which that means that my income would be down because I don't have less time to work because I'm going to school. So you kind of see that. So this is what the 8880 looks like. And remember, this credit is based, I mean, there's your contribution, and if you're married filing jointly and your spouse contributed, there's her contribution. So it doesn't kind of break it up like that. But then you come over here and you see that you look at your adjusted gross income, you find that over here, then you slide over to your filing status to find out what percentage of the contribution that you made actually is a non-refundable tax credit. And you see that, woo, those aren't big numbers. 1%, 2%, 5%. I mean, we're not talking big money here. And keep in mind, on top of this, though, your low income. We saw the caps. What's your tax load going to be? Not very big.
I'll show you. Let me get this one. I can show you.
Residential energy credits, Form 5695. May be able to take this credit by completing and attaching the 5695 being paid for any of the following during the taxable year and using in your home. Doesn't have to be your main home. It could be your cabin at the lake. But it does have to be located in the United States. So you buy some qualified solar electric property for use in your home, qualified solar water heating, qualified fuel cell property, qualified small wind energy, or some geothermal heat pumps. Any of those you can take some tax credit for. Right now, the credit is pretty good. It's terrible. It's absolutely awful. There's like a $500 credit, and that was a lifetime maximum. Now it's better. First and foremost, it's been extended to 2032. We'll see. Credit amount is now 30%, where it used to be only 10% of what you paid. So I bought and had installed, because that's part of getting it up and going, the solar panels on the roof for electricity. So whatever I paid for those solar panels and the installation and everything to get them hooked up, whatever I paid, I can take as a tax credit 30%. I am limited at per year $1,200, but it does roll over. Whereas before it was a $500 lifetime. So joke. We already talked about that. And obviously it had to be installed at least since 2022. So at that point, you're still rolling it over. But right now, so if I had something new started, like I said, I could start taking my deduction and then keep until I hit my per year max, but then roll it over and then, until I use it up. Credit is 30% of the amount paid for the property expenditures paid during the tax year and energy efficient improvements installed during the tax year. So I paid a boatload this year to have new windows put in my house, and they are definitely energy efficient, so they qualify for the credit. Well, I'm going to get a $600 tax credit this year, but that sure ain't going to be enough to cover what I paid, but I'm going to keep rolling it over. I'm going to have another $600 credit. I'll just say that I replaced 9 windows, it cost me about $15,000. Huh? Yeah, They're gonna be worth everything. Oh, yeah. I mean, my old windows, they were aluminum frame windows. They sweat in the summer and frosted in the winter. You know, they weren't doing squat. You might as well have open windows at that point, right? Not relevant. I understand why you're asking that. No problem. The fact is that I paid for it. And so I still am eligible to credit even if I don't live there anymore. I don't sold the place. Okay. I mean, it's a pretty good question. I never thought of it from that point of view, but I've never seen any rule that said, you know, once you qualify, you qualify. And that just the fact that I sold it, moved away, doesn't stop me from the previous qualification because I qualified back then. So I'm just rolling over my credits. Get new doors, $250 per year. An electric or natural gas heat pump or water heater or biomass stove or boiler, if you get the energy efficient type, $2,000 cap. Must meet or exceed the highest efficiency rating in effect as of the beginning of the calendar year in which the property is placed in service. Make sure that you have the documentation for this. I do. For my windows. I mean, it was something specifically I asked the guy. The fact is, he was one of my tax clients that just actually helped. I've been doing his taxes for years. So it was easier to talk to him because I already knew him. I knew the guy. So it made it easy to talk about. But no, I've got all the documentation I need for the IRS to prove that, yes, I've met that. I've met this rule. In fact, they exceed. But, you know, looking at some of these other things, I could see where you might need to replace your furnace. You put in a heat pump, or you need to, especially with water heaters, those things don't last forever. Well, if you have to replace, yeah.
The quality of them.
It's not too bad. I figure about 15 years on a water heater. Now, 4 years. I think you said 40. Yeah, no, something wrong there.
Right, the quality of it.
Yeah, well, you might need to warm up a little bit more and increase your quality. I don't know.
Loads.
Yeah. All right. So also, I can take as a tax credit, limited to $150. I can have somebody come out and take a look at my house and tell me how to improve my efficiency of my house. They'll come out. I've never had this done before, but I imagine what it is. They got this guy. He comes out, might be running some smoke around the windows to see if there's drafts, pointing thermal camera out all over the place to see if there's any leaks. You know, that type of thing. $150 credit for somebody coming out to do that. I'm sure you paid more than that, but at least you get something. I mean, you also have to be satisfied with the fact that I've done these energy efficient things. I'm going to get paid back anyway in lower heat bills, lower air conditioning bills. Here's our form, 5695. It'll be all sorts of fun. I'm going slow. She's ready. She's scribbling. I want to make sure she gets caught up. I'm less concerned about that one existing in future as I am about this one. Clean vehicle credit, currently $89.36. It's supposed to be extended also through 2032, but you never know. And I've heard him talk about this credit specifically. But qualified plug-in vehicles placed in service before 2023, or whatever tax year that you're dealing with, tax credit between $2,500 and $7,500 was available. Credit phases out when eligible vehicles manufactured by the manufacturer exceed $200,000. However, this new law removes the limitation on the number of vehicles eligible for the credit. No, 200,000 units, sorry. The manufacturer, so big, this credit phases out, so like, I don't know how many vehicles Tesla makes, but think about it. It might be over that 200,000. So if I bought a Tesla, under the new law, eligible vehicles placed in service after 2022, the $7,500 credit is some fancy word into two components. I've got a pretty good vocabulary, but that one just flabbergasted me. So of that, the credit divides out into two different ways. 3,750 critical minerals requirements are satisfied. So that means that the minerals in the battery to qualify for that part of the credit have to be extracted in the United States or in a country which the United States has a free trade agreement, or the minerals in the battery in the car have to be recycled in North America. Now, Mr. Trump, with his tariffs, would kind of override the free trade aspect of it between Canada and Mexico. I'm pointing at Mexico on this one, especially when it comes to recycled in North America. All right, part two. 3,750 of battery component requirements are satisfied. The percentage of value of the components contained in the battery that was manufactured or assembled in North America must be certain applicable percentage amounts. You can't have too much foreign materials in your new battery or in your recycled battery. As a tax preparer, I don't have to keep track of this. This is the kind of the manufacturer / seller of the car needs to provide this information. Is it eligible for the credit? Only one credit per vehicle. Well, that makes sense. Taxpayer must include the vehicle identification number. No credit is available unless the final assembly of the vehicle takes place in North America. So if you're buying that, who makes the Leaf? Honda? Has to be manufactured in North America, not the Japanese one. No credit is available if the manufacturer's suggested retail price exceeds for pickup trucks, vans, and SUVs. They can't sell for more than 80,000 any other vehicle, so normal cars at that rate can't sell for over more than 55. So Teslas are definitely out for this credit. They cost way too much. But again, if you're looking at a Prius, you're looking at a Leaf, you're looking at Chevy used to make a Volt. I think they discontinued it. But those cars would probably fall into this category. No credit is available for taxpayers whose adjusted gross income exceeds these limits. Of course, to buy a Tesla, I'd have to probably exceed that limit anyway. No credit is available after 2023 for a vehicle with any battery component manufactured or assembled by a foreign entity of concern. I'll let you read between the lines to figure out what that means. No credit is available after 2024 for a vehicle with any critical materials that were extracted or processed or recycled by a foreign entity of concern. And that list will probably change. $89.63 is your form for this. And really, I mean, when I talk about it, qualified plug-in electric motor vehicle credit. So basically, you are looking at cars that are just that. You got to plug them in. You're not filling up the tank and then relying on the motor to supplement the power. You got to plug it in. Which, you know, more and more of those vehicles do exist. I'm not going to talk about that credit. I am not going to get into alternative minimum credit. So let's talk about this one. This is a Schedule R. Credit for elderly or disabled. You may be able to take this credit if either of the following applies. You were 65 or older at the end of the year, or you were under 65 and you were permanently totally disabled on the date you retired. You retired on disability before 77, which at this time didn't be retired anyway. Received taxable disability income during the year, and you have not reached the mandatory retirement age. So I'm retired on disability, or I'm 65 or older. To help me start qualifying for this credit.
No cash assistance.
This credit also expires
We have no chance for.
if your adjusted gross income for the single people is more than 17. Married, filing jointly, and only one spouse qualifies, so only one of you met the criteria of 65 or older or retired on disability. Can't make over 20. If you both qualified, can't make over 25. And married filing separately and left apart for all of the year at 12,500. So this is a tax credit for old, elderly, or people that are retired on disability, but still have to work. Well, and they don't have to work because this is not based on earned income. We're looking at adjusted gross income, which is just about everything. If it's less than these numbers, you qualify for a non-refundable tax credit. This is your form. This is what Schedule R looks like. Do you have a phone?
At 10.
All right.
Okay.
Please have a seat.
Running a little behind, so I will be with you shortly. You can sit right at that desk, right, and listen to him teach class.
I don't know what you did to deserve that. You might need to go make amends someplace. All right, so like I said, this is a non-refundable tax credit. We saw the
But
income limits, so therefore it's not that great of a tax credit. Now, one thing that we do want to talk about, although it's not a big, huge, important thing for the type of people that come into this office, this is a refundable credit.
Okay.
If you or your spouse of following term return have more than one employer and the total wages of more than $160,200, that's for one or the other of you, not combined. 2 months Social Security tax may have been withheld. Yes, you are understanding that correctly. I only have to pay $9,932.40 in Social Security tax in a year. If I go over that amount, I don't have to pay it. Well, it's a whole lot going in, but I think this needs to go away. It never will. Because obviously, who's doing this? Let's talk about this rule per say. Let's see if it's talked about better on the next slide. No, we'll continue on because it's working on it. This table shows the maximum amount of wages subject to tax and the maximum amount of tax that should have been withheld. So Social Security or Railroad Tier 1 tax, which is Railroad Retirement Board's Social Security plan. They both follow the same rules. You get taxed at 6.2% goes to Social Security of your income. And like we said, we move up to a maximum rate. You shouldn't have any more withheld from your paycheck to pay for Social Security taxes than that number right there. If the employer incorrectly withheld more than the maximum, you cannot claim the credit, extra credit, as a credit on your tax rate. So, if I only work at one place and I made over $160,000, they kept on withholding Social Security. Obviously, I don't have to. I can get what they pay over back. But if I was only working for one employer, they should have known better. they should have automatically stopped. And so if I'm only working for one person, I actually have to go to them and say, hey, you made a mistake. Show me the money. The reason why it's on the tax form is because if I'm working for more than one employer and I don't go over the limit at either one of them individually, but collectively I go over the limit, neither one of them would stop because they didn't know I haven't reached the limit. That's where this comes in. I put on my income that I received over $160,200 in income. It's going to show how much I paid in Social Security tax. It's going to say, well, hey, you paid in $10,000, so you're roughly $68 over the limit. Here's a refundable tax credit of $68. It's like I said, nobody had enough information to stop because I didn't reach that at any one employer. So that's where I could do the tax credit. Married, filing jointly, both taxpayer and spouse had multiple employers. Figure the credit separately for each of them to determine if each has excess withholding. Not really a problem that we have around here. I mean, I have a couple of clients that play with this, not being around that number, but they only work for one year, only one place. So. Well, do I really want to go into that? All right, I'll talk about this just a little bit. Gas prices. You look at the price of gas at Quick Trip. There's more to that number than just the cost of gas. There's taxes involved. Well, this is geared for people that have gone. So I'm going to give you a specific use case scenario. And you can apply it however you need to whatever. But okay, I've got Farmer Brown. And he's driving around in his big old grain truck. And he looks at his gas gauge. Gas gauge says walk. Uh-oh. Well, he's not at the farm where he can pull up to his tank out there and just pull it up the diesel that he had delivered to the farm. He's got to stop at Quick Trip. So he fills up at Quick Trip, he takes it off, gets his receipt. We see that, we know how much he's paid in taxes. Being the farm, in this case, and this is a farm truck, it's not for hire, it's just used for farm, non-highway vehicle, basically. He doesn't have to pay tax on that. The fuel is tax exempt for him. But since he paid tax on it, he now qualifies for a tax credit. For instance, we talk about, you drive by a farm, you see that big old tank that's up on stilts out there, that's full of diesel. They don't pay tax on that, it's tax exempt. It's also got a special color for it, so if you get pulled over and they look in your tanks and you got the wrong color diesel in there, they can fine you. But yeah. But so we get the idea on that. To make it even easier, let's take the truck out of the equation. He pulled up in his tractor and filled it up. Well, that's definitely a non-highway vehicle. So what he paid in tax, he gets to write off as a tax credit. I'm not going to talk about that at all. All right. So we got done with this particular chapter. You see them down there? I have them for you. I have them. All right, so this is the last topic that we're going to talk about in the framework of this class. Obviously, in the basic class, we continue on. There are 20 chapters in the book. And we're only going through 12.
This chapter.
Well, I'm going to tighten it up.
I know. I remember this chapter.
This chapter can take a long time. This is profit or loss from business, Schedule C, and by default, Schedule F. Schedule C is for people that are self-employed. Schedule F is for farmers. We're basically self-employed. The two forms look very similar. F does have some farm-specific categories on it, but they behave by the same rules. So when I talk about C, I'm also talking about F. The two go hand in hand. So we want to talk about self-employment and Schedule C. We're going to talk some about what income is and what expenses are. Profit and loss calculation. If you don't have a calculator, you're in good shape. A little bit on taxpayer business use of the home. I'm not going to talk about Schedule F because if you understand Schedule C, you'll get Schedule F. And to talk a little bit about self-employment tax. All right, so you're self-employed if you carry on a business or a trade as a sole proprietor. And that's what most people that are coming in here do. So I'll use the hairdresser example as a running example as we go through this one, because it's one of our more popular ones. Daycare is also a popular one in this particular category for us. They're self-employed. They don't work for anybody else. They work for themselves. Also, though, you could be an independent contractor, member of a partnership, or your business for yourself in any other way. Okay? So, like, for instance, go to this one here real quick. Independent contractor. I used to do some mystery shopping. So I was independent contracting for these companies who take the contract. I needed to go to Starbucks. And I had this job. I took these gigs. You go to Starbucks, you order a regular latte, and you go out to your car, and you stick the thermometer in it, and get the reading, and then you put it on a little scale, and take the weight. And I got the drink for free, and then they paid me another little bit. I'm an independent contractor. I wish I could get that gig again, but they stopped that. Oh yeah. Oh yeah. I like doing the Sonic one. I like doing the Starbucks one. I like doing the Sonic one too. That was fun. The one that made no sense to me is I got paid to mystery shop for the post office. I went to the post office. I was mailed a box to take down to the post office in question and mail it. And there was nothing in the box. Fun. All right, so an activity qualifies as a business. The primary purpose for engaging in the activity is to make income for profit. And you are involved in the activity with continuity and regularity, which that's a little vague. Especially if you're doing something seasonal. Doesn't mean that, hey, it's off season. Do I need to be doing it? No, you don't. So, your business does not have to be full time. It can be a side hustle. Work a regular job during the day, and I do Lyft after work for a couple hours. That's a side hustle. I still qualify for Schedule C. And that's something that's growing with us. Those DoorDashers, Lyft, Uber.
And it's 17.
If you own and operate a business with someone else, you may be self-employed as a member of a partnership. Any income you earn from the business activity must be claimed on your tax return, even if no reporting documents are received.
child turns 17.
If net earnings from self-employment are at least $400, I have to file a tax return because I have to pay self-employment tax. Obviously, I won't have income tax at $400,
Goes to
but I will have self-employment tax,
the age of 19.
which, by the way, cannot be paid with non-refundable credits.
Or if that child goes to college.
So I'm going to talk about
and
this
you're
one
still
here real
supporting
quick.
whether you
Um,
live on campus or in your home, you still complain.
Partnership, now it can be you and just somebody else, a friend of yours, you know, or it could be your spouse. And I'm going to focus on the spouse one. For this one, I had these, there was a trucking company, and that's one of my specialties. It's Shannon's specialty too. But she was running a trucking company. She was the bookkeeper slash load finder, and then he was the driver. And what they wanted to, originally when they came in, what they wanted to do was just make one Schedule C and put his name on it, you know, fine and dandy. Okay, well, you can do that, but I talked him out of it. I talked him out of it because of self-employment tax. The reason why I did that is that, okay, if I do that, if I put his name on the business, she's just kind of the stay-at-home mom that, you know, is contributing to the business, but not really being recognized in the business. He's going to pay self-employment tax. She is not. So therefore, when it comes to retire, he's got money in his showing as credit in Social Security. She's got nothing. If I divide that up between the two of them, yes, I'm filing 2 Schedule Cs. Yes, I'm filing 2 self-employment tax forms. But now he's getting some credit. She's getting some credit for Social Security. And that's the reason why they decided to go with it. You can divide the partnership among any percentage that's appropriate. 50-50, 60-40, 90-10, doesn't matter. Self-employment income does not include rental income from real estate unless you're actually a realtor. Does not include interest income, dividend income, or capital gains or losses for Schedule C. Business income information may be reported to you on a 1099 NEC for non-employee compensation. That's probably the most common way that we see it now, especially if you're a contractor. You're going to get a 1099 NEC. The old form, the 1099 miscellaneous with income in box 7, also counts in here, but theirs is really trying to get people away from that. But it still exists. That box 7 is still there. Box 7 says non-employee compensation. But the 1099 miscellaneous covers all sorts of different things. If box 7 treated like you would a 1099 NEC, 1099K. If you're selling a lot of your stuff on eBay and you're paying, or just you're receiving a lot of payments through credit card, you know, using Square or whatever, those apps, you'll get a 1099K from them. That's showing how much sales you had, how much ran through the credit card. So obviously, that is a good document to have. It shows how much revenue you had. Very infrequently, but you could have a W-2 with box 13 checked, indicating that they're a statutory employee, which means that as a statutory employee, any expenses that they had relative to their employment for that business can be expensed. But like we said, it's a special case. Box 13 has to be checked. Schedule K1 that's being generated from a 1065. This is partner share of income deductions credits, box 14. I'm not going to give new people K1s. They're not hard, but they look scary. They have all sorts of boxes. 3 columns of boxes on one side of the page. And all the codes for all the different boxes take up at least 2 pages. And frustratingly enough, some of those boxes and some of those codes are informational only and don't belong anywhere on a tax return.
Each one has its own finance structure. You know this. So this one-
If you're self-employed, you report your business income and expenses on a Schedule
Let's say they
C.
approve you for the 500 instead.
If you're self-employed as a member of a partnership and you do not use Schedule C, you get a K1, which then will feed a Schedule C, so we're not really worried about that.
Alright.
If you're self-employed and have more than one business, report the income expenses of each business on a separate Schedule C. So now this is if they are separate businesses. I mean, separate businesses. One really has nothing to do with the other. I have a business as a baker. I have a business as a lawnmower. Two different Schedule Cs because the two don't go together. But you can be kind of generous in some of that stuff. I have a business as a lawnmower where I also hang Christmas lights and plow driveways. They're all basically the same. I only need one Schedule C. Total net profit or loss from all sole proprietors will be combined and entered on line 1, Schedule 3. And like you said, if you're a farmer, even if you're just kind of a hobby farmer, because Brenda had this one happen, she kept on, this return took weeks because she never brought everything in all at once. But she was bringing in pieces of things. And we're looking at some sales and we're looking at some expenditures and we're getting a feel for it. Brenda and I were talking about this as she was putting it together. You know, well, here's some sales from,
Look at the IRS and they're also going to.
you know, the farmer's market.
Credit data.
And here's some sales from, it just keep on, like, it's trying to paint, she says she's self-employed, but when we're looking at all the pieces of information, it's feeling like a farm. Until we finally found out about the chickens and the goats. Well, now we know we have a farm. And so she stopped her Schedule C work and started working on a Schedule F. Hobby versus business. All income you earn is reportable on a tax return. Many sideline occupations, though, are actually just hobbies. Well, it gets paid, that's great. If I don't make any money, no, well, the whole idea was just more or less to keep busy. Hobby is not considered a business because its activities are not carried on for generating a profit. This is to stop people from making a business and then running up a whole big amount of expenses to offset income from other places and pay less tax. That's the idea. Hobby income is taxable and reported on line 1, Schedule 8J as other income. The losses currently are not deductible. Now, if the Tax Cut Jobs Act expires, you might be able to put your expenses on Schedule A. But currently, hobby income expenses aren't deductible. But you do, and a little side note here, if I have income, if I had net income off my Schedule C and my Schedule F, that's earned income. It's eligible for earned income credit. Hobby income is unearned income. It's not eligible for earned income credit. Keep that in mind. I'm going to come back to that idea. One indicator of whether an activity is considered a business or a hobby is the presumption of profit. I mean, are you trying to make money? An activity is presumed to be carried on for profit if it produces a profit in 3 of the last 5 tax years. It's not, I can lose money in some years. I just can't lose it all the time. Unless I have good reasons. There's some things coming up where, okay, some bad, I'm on bad times for whatever reason. We'll come back to that. Activities that consist primarily of breeding, no, I'm not worried about that. If your activity is not carried on for profit, your deductions and losses may be limited per hobby rules. If a business cannot meet the 5-year rule, it does not necessarily mean that the business is not carried on for profit, But it definitely is a red flag for the IRS. If they look at your records going back 5 years and that Schedule C is negative for all those 5 years, they might want to talk to you about it. And of course, the IRS has a publication for that, talking about some of these things. 535, factors to assist in indicating a profit motive. So first and foremost, do you carry on the activity in a business-like manner? Now, we have some people coming here, well, I'm self-employed. Okay, no problem. Here's my income. No problem. Where's your expenses? I don't have any expenses.
I need to go.
You're not in business.
So
Well, but I am.
I'll be one.
Well, no, you're not. Tell me a business that has no expenses. If there was such a thing, everybody do it. So are you at that point in behaving in a business-like manner? I'll take that even farther. You bring in a bunch of books and it looks like it was just all, you wrote it all down in the past 20 minutes. Are you behaving in a business-like manner? If you're behaving in a business-like manner, you have an idea of where you're at. Maybe not on a day-to-day basis, but at least on a monthly basis, you're going to run the books to see if you're making any money. If you're self-employed, you should at least do it quarterly, because if I'm making money, and being subject to self-employment tax, I have to pay quarterly payments, or else I'm subject to an underpayment penalty on my taxes. Go ahead.
So I use card.
Uh-huh.
So I didn't use a card. I only worked for 3 months out of the year.
Mhm.
So like, I haven't worked at all for the rest of the year. So I did like this card. You know what I mean? Like it just takes me a while.
Yep.
And I didn't make like $10,000. Because like, so,
Well, I mean, hopefully you kept the job, a lot of your miles that you drove.
well, I have the Everline.
Okay, so that should give you everything that you need to have the expenses. You're probably not horribly at risk, because smart drivers don't make a ton of money, and you're going to get the mileage deduction. So you're being taxed at self-employment on your net, not your gross. And if you worked other places, you might have. If your husband worked other places, and he has withholdings, it might have been enough to cover you. So you're not subject to an underpayment penalty. I'm not subject to an underpayment penalty if I don't make quarterly payments, as long as I pay somehow on a consistent basis. So, I'm kind of like you. I didn't pay quarterly payments when I was doing mystery shopping, because other things that I was doing, or other things that my wife was doing, was covering the amount I should have made in quarterly payments. So the quarterly payment was made, just not in that name. So I was never behind to a point where I was in trouble. But when your only business is that, and your only income is that, and so I'm looking at my hairdressers, because those are the people that are coming in here that might be trying to work the system. Because remember, for earned income credit, there's a sweet spot. They know what that number is. It's easy. I can go on the IRS website right now and find out what that number is. And that's where I want my income to be, so I can get the maximum earned income credit. So they come in here and they shoot that number. It's like, okay, well, you need to support that number. Well, here's my journals of my receipts. Okay, where are your expenses? And they'll give you all sorts of song and dance. I mean, one time we had a maid in here, and she was like, well, they provide all the chemicals and such. Okay, well, that's fine. Did you buy any specialty clothing? Gloves or anything like that? No, they provide it. Right? Well, how did you get there? You write off the mileage. No, they picked me up. Really? Are we buying this? Are we? It just didn't feel right, because the number was in that sweet spot where we don't have any expenses. And anytime that we tried to talk about expenses, she had some sort of excuse. Not comfortable doing this return.
So expensive to make it for them.
Yeah, expenses will make your net income go down. Your earned income credits can be figured off your net income. So if they came in here with the sweet spot number to start with, then I'm looking for expenses to make the business legitimate. I'm not trying to get her away from earned income credit. If you earn it, you earn it. That's not my point. My point is making sure that I have something that can survive an IRS audit. That's my whole thing. And at the moment, I can't support this. I can't, it's not making sense to me. I'm not buying the fact that you don't have any expenses as a business. I just don't. No. Hobby income is not subject to self-employment tax. It's just under income. It's just subject to regular income tax. And so, going back to the maid, this is Brenda's client, not mine, by the way, but going back to the maid. So we put her income under hobby income because we didn't feel like we had a business here. And I do this a lot, hey, if I don't feel you're operating a business like manner, which is rule number one, are you behaving in a business like manner? If you're not, it's hobby income. Well, hobby income is, okay, you're going to report income, so I'm not defrauding the IRS. But unearned income, hobby income does not count toward earned income credit. It will help you, still on child tax credit, additional child tax credit. It'll help you in other places, but it won't help you there. And that's how, I don't want to say that's how I make people go away, but all of a sudden now they're not getting this big refund because they didn't get to qualify for earned income credit. Because I put it in hobby income because that's where it felt the most comfortable to me. You want to take your forms and try it someplace else, that's fine, go ahead. Hopefully you have better luck. I just don't want, my name is on that return. My P10 is on that return. The IRS knows that's me. 013003. That's me. I got an answer for it. Does the time and effort you put in the activity indicate you actually intend to make it profitable? Are you really working at this, or again, is it just something that I'll put a little bit of time in it, and I don't really care whether or not I'm making money? Do you depend on the income for your livelihood? Again, it's not a prerequisite. I might just be doing it for mad money. Like you and the Spark thing, Obviously, you and your husband make enough money to live comfortably. Maybe not as comfortable as you like, but comfortably. Yeah. So, that's not, this is something the IRS is looking at. So, okay, you've lost money in a lot of years. Now, are you trying, we're trying to determine whether or not this is a business thing or this is a tax, you're trying to really get an expense going.
Almost there.
So, like I said, it's not a prerequisite.
Client come in, drop stuff off.
Are losses incurred due to circumstances beyond your control? Are they normal in the startup phase of your type of business? That 3 to 5 rule doesn't really apply necessarily. If you're a brand new business, it takes time to get a customer base. It's even more interesting because I'm going to have some big expenses when I first start up because I bought a whole bunch of stuff and I have to depreciate it, which we're not talking about in this class, but that's an expense that's going on here. I might not be making any money, but my bank account's getting bigger. But on my tax books, I show that I'm losing money, and it's because of depreciation. Like the first guy who first started this franchise, he told me that, for the first 5 years, he didn't make any money. His joke was that he hired a waiver, he worked for one shift, he wet his pants, he took them home, and that guy made more money than he did for the entire year. Well, I thought about that for a while. I thought, man, I feel bad, he's not making any money. But then I realized he wasn't making any money. New computers, 7 years worth of expenses for each one of the computers. New desks, new chairs, those are 5-year property. He's deducting them over 5 years. These are expenses that are beyond his control. But that was the reason why he was showing that he was losing money. It's not that his bank account wasn't going up. It's just on the tax side, he has so many other expenses. Okay, if you're losing money, what have you done to try and fix that? If you're trying to figure it out, well, okay, this didn't work, so let's try this. Okay, I stopped advertising on X and started advertising on Facebook. What are you doing to try and make that change? Do you or your advisors have the knowledge needed to carry on the activity of successful business? Do you know what you're doing? I shouldn't run an engineering company. I don't know the thing one about being an engineer. I can run a landscaping company, and obviously I can do a tax office. I have the expertise for that. Well, Bob's joke was, the first franchisee, is like, he hated doing taxes. He never did his own taxes. Yeah, he's running a tax office. He doesn't know a thing about it. That's why he hires me, and hired Shannon, and hired Brenda, and everybody else. Those are the people that had the knowledge to make it profitable. Have you been successful in making profit in similar activities in the past? Okay, well, hey, I was a tax off, technically before I was here, okay, to run the example, I was part of a mom and pop tax office. It was a funny story. It was my wife's ex-father-in-law. I was working for him. He liked her more than he liked his own son, but I worked for him for a number of years until he died. So, yeah, that's kind of what they're looking at. Bob, he actually owned Superior School Supply. And then he sold it, retired, and got into this business because, at the time they were really, it's only open 4 months out of the year. Pretty good for a retired person. We're not looking for a big commitment, just a little something on the side. And the 4 months of the year, the worst months to go out and do anything anyway. Who wants to go outside in February? Let's see here. Does the activity make profit in some years? Again, it's looking as like that comes a little back to the circumstances. Well, you lost money in the past couple of years, but the economy is terrible. But when the economy is okay, you made money. Okay, well, that explains everything. Can you expect to make a future profit from the appreciation of the assets used in activity? That goes back to what I was talking about, depreciation. He was losing money those years because these things hadn't been fully depreciated yet. Now, once those things drop off the books, so this is a 5-year property, that's a 5-year property, computers are 7-year property. So it takes 5-7 years to get these expenses off the books. If we take the depreciation off the equation, is that the reason why you're showing a loss?
You could call.
Business records are used to prove the source of your income as well as to support deductible expenses and credits. Records must always be available for inspection by the IRS. You better have it. If they call you in for an audit, you better show up with boxes or flash drive. That's our big thing right now, isn't it? Because receipts, you think about thermal paper, it's not as bad as it used to be. You think about thermal paper though, stuff fades over time. And maybe the day that I, put it in the computer as expense, I could read it plain and clear. That's fine, great. 5 years from now, it might have faded. If the IRS looks at it, they can't read it, they throw it away. They don't try and figure it out. Can I read it? No, trash. Then they throw out the expense. Well, you didn't prove it. Well, it's on that piece of paper. I can read it. We didn't prove it.
And there should be a
So if you have stuff like that, it's like, take a picture of it. Scan it. Save it digitally. Those don't fade. Business checking account should be open to keep your business transactions separate from your personal ones. That's not a bad idea. In addition to a checkbook, canceled checks, deposit slips, bank statements, other records need to be maintained. Include sales slips, invoices, receipts, delivery receipts, inventory records, and any financial statements. Now, I'll go so far to say that I don't necessarily need an individual checking account. But I could do something where all my expenses are still separate by itself. Go get a prepaid card, and that's what it's for. That way, all the business is just on that card. That meets this requirement. It also helps you on your expenses, because not only do I have the actual receipt of when I went down to Lowe's and charged it,
I just want to marry.
it's also on my credit card statement now. So I've got it twice.
Did you bring residency card?
Amounts spent on meals, travel, gifts are subject to additional documentation requirements. That's actually one of the other chapters that we're not going to talk about. I'm going to say that meals, only 50% of what I spent is deductible, and it had to be for business reasons, whether I was entertaining a client or I was out on the road on a trip and couldn't get home. Travel, I can take, that's pretty much whatever I spend on travel that's business related, I can write off. There's no real big thing. Gifts, limited, $25 per person for the year. To be deductible, all expenses must be ordinary and necessary expenses of carrying on the business. Hey, if I'm a Bible salesman, I don't think the IRS is going to be too keen on all the receipts from the strip club. I might be saying I was trying to convert them, but I'm not sure they're going to buy it. Schedule C is 2 pages, front and back. It's divided into 5 sections: background information, income, expenses, information about your vehicle, and then actually figure out whether or not you made money. So this is what it looks like.
Yeah, if you turn it straight, it doesn't fit.
So what we have here, again, up here in this part, up here, we're talking about telling the IRS what the business is, telling them about the business. We're also saying who it is. If we're married filing jointly,
I know.
I have a Schedule C on my tax return.
I get all
It has nothing to do with my wife.
wife.
She's not involved in that. Then down here, this has to do with income. This all has to do with expenses. We'll talk about some of these lines individually. This talks about cost of goods sold, and I'm not going to talk about COGS at all. Most of our clientele are service people. They don't make stuff, so they don't have cost of goods sold. This section has to do with car information, which is going to be feeding our auto expenses. So we're identifying what we're driving. This part right here is other expenses. If it doesn't fit into any of these categories, that's where you put it. So first and foremost, we put in the taxpayer's name and social security number at the top of the Schedule C, so we identify whose Schedule C this belongs to. Line A is for the principal type of business or professional activity, including product or service. So we want to describe what we're doing. Don't enter a name from a company from 1099 NEC. There's a line there for company name, and if you actually have one, then put it in there. If you don't have one, that's fine to leave it blank. As the Spark driver, did you get an employer identification number, or did you give them your social security? If you go back to that or do something like that, I suggest that you get an employer identification number. It's free. You just have to print the form out from the IRS and mail it in to them, and they'll send you back an employer identification. I have one for my mystery shopping. That way, instead of giving all these individual companies my social security number, I give this employer identification number, which is basically a business social security number that the IRS then brings back to me. But it's not, I mean, it's hard for identity thief to do anything with an EIN. So I recommend doing that. But part of doing that process is you come up with a business name. So for my mystery shopping that I was doing, I called it Ghost Services. That was the business name. Made it sound like I was a ghost hunter, but you know, for mystery shopping, I thought it was somewhat appropriate. Line B, enter the appropriate business code. The IRS has come up with a list, pages long, of ways to identify what type of business that you're actually doing. So for instance, there is an actual business code for tax preparation services. I don't remember the number, it's like 556363 or something like that. I mean, it's a big number. But when the IRS looks at the code, they know what you're doing. The list is hard to negotiate. It doesn't really flow in any method that really is identifiable. It just seems kind of random. So we open it, we put it as PDF or something like that, and then we type in the search bar an activity that's what we're doing, and hopefully we can come up with a hit that's close. And just come up with the closest activity to what you find. So, you know, my plumber. Well, there's not a plumber, but there is a couple of different categories under construction that he fits into. So just choose the one that's most appropriate. If there's a separate business name or a business address different than the one that's used on the return, enter that information on that line of Schedule C. If you have an employer identification number, enter it on line D. Do not use your social security number. If you don't have an EIN, leave it blank. Do not pull off any number EINs from a 1099 NEC or a miscellaneous and put it there either. That's not where it goes. Here's the one. Tax code there at box B, 541213. That's for tax returns. So Mr. Patel up here, he does taxes. His business name is Many Happy Returns. Boy, it could be much cornier than that. Line C, or Schedule C, line F, you must indicate your accounting method. Most of our people are doing the cash method. Talked about what a cash method is versus a accrual. I'll mention again. Cash, I count it when I do it. I pay the bill, that's when it's expense eligible. I receive the payment, that's when it's expense eligible, or receipt eligible. Accrual is just the opposite. As I do the activity that causes the expense, that's when it becomes eligible. It has nothing to do with when I actually pay it. When I do the work that causes me to get paid, that's when I report it as income, not when I get paid. That's the difference between cash and accrual. It does ask if you materially participate in your business and whether or not you perform these business activities on a regular, continuous, and substantial basis. Not that any of those are necessarily requirements, but it does help. I mean, like I said, if I'm making Christmas ornaments, I really don't need to do a whole hell of a lot in March. I'm not going to fairs. I'm not really going to make a whole bunch, but you can see, so coming around maybe in June, I'll start thinking about Christmas in July or something like that. But it had nothing to do with the fact that, I didn't do it every day or I didn't do it every week. That's not really what they're looking at. Just the overall question, is the time that you're putting into the business significant? Is it
Yeah.
substantial in the regards of what the business actually is? If you started the business, there's a box on line H to check that tells the IRS, well, hey, I'm probably going to lose my shirt this year. And this is the reason why. I'm a brand new business. If you made payments that require you to issue a 1099, which again, that $400 comes into effect. So I hired a subcontractor. Did I pay them over $400? Yes or no? That's one part of the question. So did you make any payments that require you to file a 1099 NEC? Yes or no? And if you did you actually do it? Yes or no? Income. Start with the gross receipts and sales, which is if I had a 1099 NEC or a 1099 miscellaneous and I put it into the computer, that's where it will go. Also, if people just come in with their journals, my cash receipts journals, they're not working contracting. They're working for themselves, the hairdresser, the daycare people. Well, they come in with a ledger. I mean, I have no problem with that. As long as it doesn't look like you wrote it last night. That's where those numbers go. Line 1 of this part. If you have a checking account or something that is paying interest, that does not go on Schedule C. It goes, for some reason, even though it's your business account, they want you to treat it as personal income. Line 7 is your gross income. Talk about the 1099 NEC. That feeds line 1. You can have multiple feeding the same Schedule C. Returns and allowances, which that's more or less if I was actually doing selling goods. Hey, they returned it because it looked like that. Or allowances. I have amount of. I'm a baker, and so I have cost of goods sold. I had to buy flour. I had to buy sugar. I had to buy milk. Well, allowances. Some of the allowances in there that would be offset of my income. In fact, I had spoilage. The milk went bad. I'm not talking about costs. Expenses. Most expenses that you incur in your business are deductible. I mean, that's pretty much it. As long as it's for the business and it's useful to the business. Or in this case, ordinary and necessary. Pretty vague, isn't it? Ordinary expenses are those that are common and accepted in your type of business. Ordinary. I mean, in a tax office, it'd be ordinary and expected to have expenses to do with paper, toner, pins, staples. Necessary. Those are appropriate and helpful to the business. Rent. That's necessary. We've got to have someplace. Electricity. Internet. So we're going to go through the lines. So you think of that middle section, that box that had a whole bunch of 2 columns. So we're going to go line by line. Advertising costs, line 8. These are promotional costs paid to enhance the business or deductible. Examples of advertising include classified ad, business cards, mailers, television spots, promotional brochures. Even if you paid up on Google search, you bought ads on Facebook, all of that would fall under this category. Auto and truck expense are costs paid to operate your business vehicle. The expense has numerous requirements. Regarding the business use of the vehicle, which actually is more of a different chapter, but basically, I strongly recommend taking the standard mileage rate as opposed to actual expenses. Because especially if you have a car that you use for both business and personal, using actual expenses starts to get really sloppy because I've got to figure out how much of my use was actually business and how much was personal, and I have to take all my expenses and divide it out. If I just take the standard mileage rate and write down every time I drove for business, it's a hell of a lot easier. Commissions and fees. So I word of mouth. Say for instance, I just what we got the Cinda Friends. So if we paid out a $50 Cinda Friend, it had nothing to do with the fact that they work here. It's just that it was a commission. You sent us a friend, it cost us $50. Here you go. Well, this is where I spent it. Contract labor, this is where I was talking about. It's like, okay, you know, I hired somebody else to help me do the work. My plumber does that. Sometimes he's got a big job, he needs a little bit of help, so I'll find some other plumber to help him. That's where that expense, what money he paid to that guy, shows up.
Yes.
He does.
Depletion, I'm not so much worried about that because it has to do with natural resources. Yeah, not too many mines around here. Employee benefit programs, I'm not going to spend a lot of time talking about employees because none of our businesses have employees. At most, they have some people that are contractors. Most of them is just them. They provide their own. Insurance, costs related to the operation of your business are deductible. Deduct payments for liability coverage, business property, fire, theft, robbery, but not for your home. Except if you do have a home office, then you can take a portion of that. So down and dirty on this one, because I'll just talk about it here, so I don't have to talk about it later. I could take a percentage, if I have a home office, I could take a percentage of everything that takes to run the home. I can take a percentage of those expenses off as a business expense based on how much percentage my office is relative to the entire house. So if I have 500 square feet and I have a 10 by 10 room, so you can see, okay, well, 500 square feet, 10 by 10 room, that's 100 square feet. I can write off 1/5 of my rent or my mortgage. I can write off my mortgage interest. I can write off 1/5 of the gas bill, 1/5 of the water bill, 1/5 of the house insurance as an expense to my business. And that's why these people that come in here and say, well, you know, hey, I'm a hairdresser, I don't have any expenses. Well, where do you do it? Well, I do it at the kitchen sink. Do you really not have any expenses? Ran the water, lights are on. Health insurance, though, does not go on this line. If you're self-employed and you buy health insurance, you actually have a better way of doing this. You can take your premiums off as an adjustment to income instead of an expense. Which actually kind of sucks because that means I'm going to pay more as self-employment tax. But at least I made my income tax go down. Interest on any loans used to finance for your business. I can write off the interest payments. That's an expense. Legal and professional services include fees for tax advice and tax preparation, as well as legal fees related to business matters. So, for instance, I have my clients coming in with Schedule Cs. I can write off on their Schedule C what it cost me to make their Schedule C, not all their taxes, just their Schedule C, last year as an expense. Office expense includes the cost of consumable office supplies such as paper, toner, and postage. Pension and profit sharing programs, I'm not gonna talk about. Rent or lease, obviously. I mean, the boss here pays monthly rent for us to be in this location. It's an expense he can put off on his, Schedule C. Repairs and maintenance includes the cost to repair and maintain the business property, tools, and equipment. This includes snow removal, lawn care, cleaning service, labor supplies, and items you spent on repairs and maintenance that do not add value or increase the life of the property. I can have, well, they got a lawnmower out here, so let's just go with that. I could pay somebody to change the oil and sharpen the blade. That's an expense. It didn't add value to the lawnmower. It doesn't make it more valuable. That's got a sharp blade and new oil. And it didn't increase its useful life per se. Now, so it's an expense. Now I take that same lawnmower and I replace the engine. It's not an expense anymore. It's a depreciable item because I've increased its life. I've got a brand new engine on it. So I'm starting at zero. And I've increased the value. I mean, would you rather buy a lawnmower that has a used engine on it, or would you rather buy a used frame lawnmower that has a brand new engine on it? Which one would you rather buy? I'd have to depreciate it. If I'm fixing it myself, I can subtract off so I'm the lawnmower guy and I sharpen the blade and change the oil myself. Well, I can expense off the oil. I can't expense off the value of my time to do this. Supplies includes the cost of materials and supplies not including the inventory. This one's always been a fuzzy to me because you have office supplies as its own expense, and then you have this supplies as another expense. Yeah. It's like business cards.
They took taxes out of it.
I don't have to necessarily justify. It says it's advertised. Yeah, I see the point. It's advertised. It's also an office supply. I can put it either place. It's not like the IRS is going to yell and scream, "Oh, that's nothing."
That doesn't affect this.
Taxes and licenses. If you pay taxes, woo. Or you need to get a business license. That's what this line's for. That's for payroll for employees. I'm not worried about those. Already talked about travel and meals. Utilities directly related to your business can be deducted. Like so, for instance, obviously, when Brett gets the cable bill, because the phone is also through the cable, so when he gets the Cox bill, it's a utility. Other expenses is that the addition of everything that's in that that area on the bottom of the second page. Added together, and it carries back to this line 27. If you can't figure out where to put it in all those other categories that we just talked about, put it in another expense. And sometimes I put things in other expenses even though they might actually fit in the category. So for instance, when I'm talking about my truck drivers, one of the things, there's a whole bunch of stuff on there that just don't work anywhere. Insurance does. That's no problem. But say like, for instance, if they went, I could put diesel under supplies, but I'd rather put diesel as its own line item on other expenses. That way, the IRS, instead of looking at $100,000 in expenses and supplies and them going, what the hell? When it's under other expenses and they see $100,000 and it's labeled diesel, makes a lot of sense. Less likely to want to look into that. My truck drivers, other things, showers, scales, all those things would go into this category. Something I cannot deduct, though, as an expense, they got a parking ticket. Speeding ticket. Can't break those off. Those aren't expenses. Yeah. Now be careful.
I knew I had.
Be careful. I actually had to come to a rescue of one of our truckers because we said you can't write off a parking ticket. She's looking at this ticket for parking. Well, you've driven past 21st Street and 135 recently, and you see that there's that Love's truck stop up there now. Oh, there's a Love's truck stop here in town. That's not relevant to what I'm saying. But there's always a bunch of trucks there. Just park. They have to pay. So if she was looking at it and it says parking ticket, she thought it was a parking ticket. No, it's a parking ticket. So they could park at Love's. That is an expense they could take.
That's additional child tax.
Yeah, that's not the violation. That's permission.
Child tax, right?
And so when I talked to her about it, okay, you know, I understand where the problem is, and this is how we deal with it. This is not a violation. This is permission.
But
Not all of them charge, but some do. Because, you know, because part of that parking ticket to allow them to park there, they will get the Wi-Fi password. So instead of, you know, running up their cell phone bill on their hotspot, they can log into the Wi-Fi there at the truck stop. You know, and sometimes you don't have to pay for parking because I think in some places if you fueled up, you know, then it's a benefit that you get. Because you don't see very many trucks pulling away from the diesel, the number's less than 1,000.
Right.
Well,
Right.
and remember, you know, Shannon's husband is a driver. Matt is used to drive. That used to be his occupation.
I see that.
Yeah.
It'll fall right under your federal. Okay, so you can.
Expenses are total, then subtracted from your gross income to give you a tentative profit or loss.
Right.
May be able to deduct expenses for a portion of your home. That's figured in this next section. And then after you get done with that part, you have your net profit. That goes back to line 31 and line 3 of Schedule 1. This is also feeds your Schedule SE to figure out what you owe in self-employment tax.
Let's say you don't call
There's some at-risk rules that limit the amount of losses I can write down on my tax return. At-risk rules apply to any activity that's carried out in a trade or business. Generally, these rules limit the amount of loss that you can claim. Check 32A if you're personally responsible for all financial risks in the business, and otherwise check 32B. Most of our people are all at risk. They're not incorporated. They're sole proprietors. They're limited liability corporations at best.
So I'm guessing that this.
So if you're not at risk, any losses that exceed what you are actually at risk for, if I go over that number, I can't deduct it off as negative income. So, and also kind of depends on a little bit on my participation. You know, if I'm receiving Schedule C income, but basically, you know, I don't have a lot of say in the way the business. I'm a part of a partnership, but I'm a 10% partner. So I don't have a lot of say in what's going on. So I'm not as at risk as the 90% partner. So my losses will be limited. I already talked about this. If I use part of my home for business, I can take some of my expenses. Now, there are some other rules that we have to apply to this home office deduction. First and foremost, this has to be the principal place of business. This test admit if you use a portion of your home as the place that you do most of your business. You don't have to do it all there. You just have to do most of it there. And sometimes, you know, it doesn't make a lot of sense. And so, and we're not looking at how much of a percentage of business that takes place at one particular location, because It doesn't always make sense. Okay, I've got a business use at home, but I hardly do anything there except pay or except write the checks. Because I'm a lawnmower. I can't bring the lawn home and mow it and take it back.
Last year.
I do most of my work out there, but I still qualify for principal place of business use of the home because of other circumstances. If you have more than one location, you must assess the relative importance of the business carried on in each location and the time spent at each location. But that's only if, like for instance, when I was working for the mom and pop, the first couple of years that I was actually working with Jim, he had an office in Marion. He was working out of a converted garage at his house in Marion. I actually don't qualify for any taxpayer's business use of home because I didn't see any of my clients. I went to the client's house. So I wouldn't qualify for any of this because none of my activities actually took place at my house. I think I'm going to write to corporate and ask why they have a North Korean flag on this slide.
But I know that doesn't mean right. But guarantee anything, right? Okay.
I remember get everybody started in
But would you like to?
I thought it was earlier on because I was actually going to say something earlier, but I could never find it again. But now I know where it's at.
I will not give them any changes to estimated taxes. Once we submit.
Already talked about that aspect of it.
That's what I was just looking for, where it's mentioning the real thing,
Mhm.
but it's not in this chapter either.
Yeah, no, that was in the that was in the travel one.
That
So
was in the.
yeah, so I think that's what, chapter 15 or something like that.
Right.
And there's no locations that close to that.
You do not have to use the entire room exclusively for your business. You just need an identifiable part of the room that can be used as your office if it's used exclusively for your business. So a hairdresser uses a designated section of her family room exclusively for business. This part of the family room does not qualify as a home office. So basically, if you're going to say that you have a home office,
Okay, I'm running just a tad bit behind.
it has to be exclusive use.
I'm gonna get you started on.
So but it doesn't have to be an entire room. I mean, it can be just a table. That's the percentage of you can use when you start using business percentage use of home. Okay, well, the table is, this is my desk. The only thing that happens at this desk though is work. If I have something else, if I have personal business, I have personal correspondence, I have that desk. Children have homework, they use that desk. They don't use my desk.
Okay, alright. So you won't have to worry about any of this. Do you have electronic check stubs or do you have?
Daycare is another problem.
Okay. In the meantime, you can work on. sending them
Daycare
to
doesn't
this
have an exclusive
email
use of
right
home.
there.
If you have in-home
I do
daycare,
need residency on the kids. So-
little rugrats run all over the place. So I don't have an exclusive use of home.
Make sure you turn your phone sideways so you can.
So
see
they're
their
gonna-
name and your address.
We have to come up with some special rules to help them out.
Email it to that address.
If you use space in your home regularly for daycare, you may be able to deduct business expenses even though you also use the same space for personal purposes. That TV room during the day, that's where the kids are watching Barney and Bluey. I don't know if they watch Barney anymore, but they watch Bluey.
We'll talk about that.
At night, we're watching whatever we watch. You know, the family's sitting there, we're watching the TV. You know, I don't have to worry about exclusive use in the daycare setting. Qualified daycare provider is a person who has state approval to operate a daycare center and family or group daycare home or be exempt from having a license because of state law. But technically, if you're say you got a daycare, I should ask for your certificate. Are you actually a daycare?
It's not pertaining to this, but everybody knows that you're doing one thing, right? Okay, so they're doing a remake of it.
Why?
I don't know, but just sitting on the TV. And he's 90 years old. Oh,
Oh, yeah, I did hear about that part of it.
right?
Now, I could do actual expenses, but there is also a shortcut. If I lose in 8829, there's a formula that's basically giving you about 300 square feet. It's a simplified use method, and I really recommend going that way when you can. It's just simpler. So instead of having to figure out how much you pay in utilities and how much you pay in all these other expenses, if I just use their simplified use formula, it's like the mileage equation. If I use business use miles, their equation, it covers the 55 cents a mile, the 60 some odd cents a mile, whatever it is, whatever year, covers the wear and tear, covers what would have been a depreciation, covers the gas, covers the oil, covers the use. Same with the business use of home using the simplified method. In the formula is built in the lights, the water, the gas, the interest on rent or what have you. So less questions. If I use that, the IRS is not going to audit me for using the simplified method. And like we said, we need to come up with a percentage of home. We can use any reasonable method to come up to figure out what my business use percentage of home is relative to the entire home. If I got 5 rooms, they're all basically the same size. One room's business is my home office. 1/5. That's fine. If I just figure out, okay, like my room's 100 square feet, 1,000 square foot house, I got a number. But if I'm a daycare, not only do I have to look at the rooms that are available for the kids to be in, because obviously there's going to be some rooms that they're not allowed to be in. They shouldn't go play in the furnace room. They shouldn't have access to the place where I keep the bleach. But for all those other rooms, since it is a combined use type thing, so not only do I have to look at how much house is available for them to play in, I also have to look at how much time I'm open. So not only am I, square footage available to play in is one part of the factor, and hours out of the year is the other factor when we're doing daycare. So for an example, we have Christina, she's running a daycare out of her home, 4 hours a day, 5 days a week. She uses 80% of her house. So line 4, she multiplies the day per year that she operated the daycare. That's 5 days times 52 weeks. It's 260 days. By the hours per days that she was open, she's only open 4 hours a day. Take that times the 260. So for the entire year, she's open 1,040 hours. Line 6, she divides 1040 hours by all the hours in the year, 8760. She gets a percentage of 11.87%. So in this case, 11.87% of her utility bill is deductible. 11.87% of her rent is deductible as an expense to the daycare. I like you looking around over there. I know that it's hard to follow along sometimes. Well, yeah.
I mean,
No, maybe
you
it's-
would say anyway,
Yeah.
so
Okay, this is basically explaining.
my brain isn't.
I know you're really getting exposed to a lot. I mean, but I will also again say, rapid class
something
Yeah,
like
you
that.
get exposed to a lot of ideas really quick.
And so
but
they'll send you-
It's not a total discount. I mean, we don't look down at people that, well, you just came from a rabbit class, you're no good. No, that's, no, we don't. Some of the best
And I
preparers
don't know if they,
in the
like,
entire business came out of rabbit
Then,
class.
or what you do, if they're not going to start harassing you. You know, but this one, if they did the big one, but I wouldn't change it to anything. It's really, I'm understanding it more now.
Well, yeah, and if you only took the rabbit class this year, I do recommend you take the facing class next year. You'll see this same thing, but we can talk about it in a little bit more detail.
Right.
We can take a little bit more time. And then Matt will be here, so
So
he'll,
will.
yeah, no, Gary probably won't, but
Does he don't come every year?
no, he doesn't come every year. He wanted a refresher.
Right.
But, you know, Matt would be here, so he'll talk about things. Sometimes they're rabbit trails.
Yeah, and confuse you even more.
But, well, you know, all the other chapters, we talk about all the chapters. I mean, 8 weeks, 20 chapters. Twice a
No,
week.
not chapter 20.
Except I didn't do chapter 20 this year because I'm going to do that on Policy and Procedure Day, which I'm looking at the 4th, but Shannon and I were kind of talking about that a little bit. I'm not convinced about the 4th yet. I will make a decision by next
Well,
week.
you need to put a little more. Because we're looking at a class that following week.
Yeah, I'm looking at doing a rapid class, and it was more for people at Stillwater, but I've actually got 2 in seat now, ready to go. So I'm not so sure that running a policy and procedure meeting before putting on 2 more people is a good idea.
Make some copies of this.
Due diligence. And that's part of the reason why I keep skipping it, because I'm going to cover it. I'm not blowing it off because it's not important. I am blowing it off because, Huh? yes. I mean, part of me wants to do it on January 4th and just kind of get it out of the way. But part of me also doesn't want to do it on January 4th because my wife and I have season tickets to the Wichita Wings. They have a game at 5 o'clock. And so normally policy and procedure runs to 4 o'clock. But I can get it down to maybe 1 o'clock. But even then, I'm not sure that it's something I want to do. And again, with 2 other people maybe coming to work for us after that, is it worth that day? We're looking at the next Saturday, whatever that one is. And it's a paid day, by the way. So on that policy and procedure day, if you get invited to it, it means I want you to work here. If you want to work here, great. We're going to fill out the I-9s, we're going to fill out the W-4s, and then we're going to talk about some, chapter 20 and a few other things. I mean, it's not. It gets long when I do it the long way because I got a bunch of videos from the IRS that I show that Shannon can't stand. They're so corny, but I like the fact they are so corny because you remember them. See, Brenda would be the opposite. You got to show them. But
And if you knew Brenda, she's got a lot of excitement going on. I mean, I could picture her.
Brenda is actually.
so Brenda.
Yep.
All right, I do want to talk about this one because we're talking about the difference of direct expenses and indirect expenses when we're talking about business use of the home. And sometimes, we've focused on indirect expenses, being able to write off the gas, the water, things like that. But what if I have my room painted? That's a direct expense. I don't have to discount it by any percentage relative to business use of home because the only thing I could paint it was my office. So I can write off all of it because it's a direct expense related to the business use of my home office. So I don't have to discount any of it. I can take off that full expense. If I got new carpet in my office, even if I had the entire floor carpeted upstairs and it just happened to, okay, they ran into that office, you can get your contractor to say, especially if you did it in a different color or something like that. Okay, how much of this was for that room? And get an individual bill for it. And then that way you don't have to worry about trying to figure out percentages. This is direct expense. This is how much the carpet costs, this is how much the installation guy costs to do that room. I'm not talking about depreciation. That is an entire chapter in and of itself. All right, so say I was limited on the amount of money that I can take as loss this year. Well, like anything else, like a lot of other things in IRS, just because I couldn't take it all this year doesn't mean it goes away. I keep track of it and I can use it in a later year. So for instance, my truck driver, for instance, on paper, on taxes, he loses his shirt. And the reason why he loses his shirt is because of something called per diem. It's a formula written by the IRS saying, okay, you're not at home, and so instead of you trying to keep track of every meal that you purchased, every drink that you bought while you're out on the road, we give you a allowance per day called per diem per day. And so it's like $63 a day. So every day that he's out, not including the first day or the last day that he's out, he has an automatic $63 expense. Whether or not expense is $63 is irrelevant. If he could get by on having a hot dog that he paid 99 cents for in a big gulp, and so he spent $1.98.
Well,
Okay, it's
they
probably
won't
more
let me
than
know.
that, but you see, he's allowed to take this big, huge expense,
If they don't give us the majority.
even if he didn't actually make that big, huge expense. But that's the reason why his income shows negative. Hey, just come in.
It's open. It's open.
Oh, well.
Anyway, sorry. I shouldn't call you.
I'm not sure I want it anymore. Feels like junk. Hello.
Go back in my system, and I can see.
So he always has negative income because his only business, his only income is this Schedule C from his truck driving. And so he has negative income. Well, if I can add it to it, and if any year that he, so like last year for a while, he worked at Spirit. And so I was able to make some of his Spirit income actually not taxable go away because he had this negative loss that he was carrying over from previous years. Already talked about the simplified method. If you run a daycare, one of the expenses that you might have is food. Well, again, instead of having to keep track of how much you paid Dylan's to buy all the food, and unfortunately, you know, it gets a little bit more complicated than that because you probably just didn't go to Dylan's to get food for daycare. Probably got your own groceries while you're there too. And now I got to go through line by line to figure out what was for business and what was for personal.
Remember what a Centipede is?
Yeah, you did.
I don't have to.
Coupon and.
Yeah.
The IRS has a formula for
Some on
you.
the back of this.
So living here, every child that's at my per day. So, I have one child, and they're there for breakfast. I have an automatic expense of $1.66. Whether or not I actually spent it, that's not relevant. $1.66.
Right, but
They stay for lunch,
you didn't remember what you.
automatic expense of $3.04 every day. Stay for dinner, $3.04.
Okay, there's
Service
a copy of the
snack,
bank
which I
paperwork.
think
I will start a
I
file
can
when you're
do
ready
this.
to. You have
I want to say
everything ready,
3
just
times
call.
a day. It might be 4, I think, but it's 3 times a day.
You can ask for Shane if you want Shane to finish, or I'll
So we
finish,
can
or
do
whatever.
97 cents for every child every day that they have a snack. Okay?
Is that written on the back that it's allowed for you to pick it up? Do you want to see something like that?
And then Schedule F is just Schedule C for farms.
I don't know.
I don't have a problem with that.
You don't even.
No, I know her. I've seen her enough,
Okay. I know her through Susan, but I just don't know
I was
her
here-
well enough. Okay.
and I actually think I did hear something about that. To tell you the truth.
Okay.
Yeah.
I can get my mom on.
No, you're fine.
Nope, nope. If the boss says you're good, I'm okay with it.
Thank you.
Okay, and it was still, what's her first name?
It's Vicky Ludlow Delgado.
Ludlow. I know that name.
Vicky Ludlow Delgado.
I definitely know that name.
All right, I'm gonna go back there. There's one thing about Schedule F I do want to talk about, and it's this, not the cow. Where'd it go? This 1099 PATR. You thought you were done with 1099 abbreviations, didn't you? This is income to the farm for not doing the damn thing. I have pasture land and set aside that, okay, I'm not gonna do anything with. It's set aside. I can't farm it. And the government's gonna pay me to do that. So they send me my payments, and then at the end of the year, they send me a 1099 PATR, or it might be on a 1099-G. Either way, that's counted as income to the farm. Even though I'm not doing anything, I'm being paid not to do anything. But it's farm income, it goes on the Schedule F. Oh, yeah. Self-employment tax was figured on Schedule SE. So if I have a net profit from my farm or net profit from my business on Schedule C, that net profit number feeds this form so I can figure out how much I owe in self-employment tax. Is it in her file cabinet? Does it look there?
Maybe not, I don't know. Oh, don't worry, I'll check at home, don't worry about it. Don't stress out
Well,
with
I
me.
can't even find a packet. I am gonna stress out.
Oh,
He's looking, hold on. Yeah, I had 22 Mom,
okay.
and I had yours for 23.
Am I allowed to take those? Okay.
Our biggest problem is that Susan got sick on the last day of the tax year.
Right.
And then never came back. So some things, she had her own little.
These aren't even in the packet, so I'm just gonna give it to them. There's the two that I did find. Okay. Yeah, I found this. It's your mom's. Sometimes our system doesn't have.
One, 732.
I'll have to do some searching for it.
No, it's no biggie.
It's been done, we can see that it's done.
No, she just wanted to have it from her
Right, you
resume.
might check and make sure she doesn't have it at home.
I will do that, because that very well could happen.
We will, we're gonna get ready to go through the file room here shortly.
All right, so self-employment tax, like I said, it sounds bad, but it's actually not. Self-employment tax is what you would pay if you're working for the regular job and Social Security and Medicare taxes. So, in one regard, you're paying your future self by paying self-employment tax. Like I said, if you have to file a tax return if your self-employment tax net income is more than $400, because that's where it starts making the formulas valid for all of them. Or you have to fill out self-employment tax if you had church income and they weren't withholding for self-employment tax if you had over $108.28. Of this, we're looking at, like I said, Medicare and Social Security taxes and self-employment tax. So, for instance, when I talked about that partnership of the company where the husband and wife are both working, not only did I have two Schedule Cs because one was for one was for the other, but that also causes two Schedule SEs. Again, one was for one was for the other because individually they were paying their own Social Security and own Medicare taxes
As long as.
to their own account.
If I can see all three kids.
Because again, on the SE, again, it identifies who the taxpayer is and their Social Security number right there at the top. So on Social Security tax for self-employment tax, self-employment tax rate is 15.3%. Of that 15.3%, 12.4 is for Social Security and 2.9 is for Medicare tax. That's fairly consistent. So, but here's the thing where I kind of caught myself after a while. I had a guy that he was self-employed only. That was his only income, and so I had to figure out his quarterlies. And you're sitting here at IRS world, and you think, well, income tax. You need to figure out what his income tax is. That's not the whole picture. He's self-employed. I not only had to figure out what he would be owing in income tax, so what tax bracket are you in? But I also have to think about his self-employment taxes. So instead of saying, hey, you only need to, you're in the 15% tax bracket, you need to hold 15% of your net profit and send that in as quarterly payment. No, he needs to look at 30%, 15% for income tax, and another 15% for self-employment taxes. So every quarter he would do a rough estimate of his books to figure out whether he's making a profit or a loss, and then sending in a quarterly payment based on his net income off the 30%. I think I was using 32 because he's a little bit higher tax bracket. So, so when you're setting up quarterlies, don't just set it up off the fact that it's income tax for self-employed people. You also have to remember their self-employment tax. Again, the same thing applies if they have net profits over $160,200. They are no longer have to find the right word for it. They no longer have to pay Social Security tax, and the Schedule SE will account for it. Schedule SE, the tax itself shows up here on this schedule, which then feeds the 1040 after the non-refundable credits. But the other thing about self-employment tax is that
As far as it's gonna go.
one half of it
But at least,
comes here to adjustments to income to decrease your taxable income. Because when you're working for somebody and you see your W-2, it shows how much you paid in Social Security tax. Half of that number that's getting paid for you in Social Security taxes and Medicare taxes, you are only paying half of it. The employer's paying the other half. Well, what if you're the employer? That's why they put this adjustment of income in
Where
here,
it just said household.
to kind of make it fair.
This one is good.
Okay, you owe the entire thing. If I'm working as a W-2, I owe the entire thing. It's just that right now it's set up where I pay half the employer pays half. Well, here,
Give me something.
like I said, as an adjustment to income, half of what you owe in Schedule SE, half of what you owe in self-employment tax comes back here as an adjustment down to income, lowering my taxable income. And one thing that we're not going to talk about in the scope of this class, but I will talk about it right now, there's another part of the 1040 having to deal with self-employment income, and that's something called QBID, Qualified Business Income Deduction. Now, I'm going to keep it very simple. It's just slightly, well, I'll go ahead and talk about it real quick. So qualified business income deduction, not only we're talking about, it's separate from this. It's a, before you figure out tax credit, it decreases my net income by 20% before I go figure my taxes. Qualified business income deduction. So I subtract my net 20% of my net income from Schedule C or F away from my taxable income. There's an exception to QBID is if my business is based on my reputation, then I'm not eligible for QBID. So to put a quick idea in your head of what that means, Michael Jordan, for instance, he signs a contract with Nike to sell Air Jordans. Had nothing to do with him. It's all about his reputation. He doesn't qualify for QBID.
Okay, so I have.
So taking that a little bit farther, a doctor doesn't qualify for QBID per se because nobody's going to go to the guy that's been sued 20 times in the
I
past
have,
month.
no, I have Wesley, I have Alfred.
Engineer, nobody's going to go to the engineer whose building
and
just
I have
collapsed.
Senator.
You know, so on and so forth. Where your reputation is the driver behind what you're getting the business for. Oh, if I have multiple Schedule Cs, I only need one Schedule SE per person. So I can have two Schedule SEs if I have married filing jointly, but you know, one's for each of them. But if I have multiple Schedule SEs, what's up?
So we can get back to work very soon.
Okay,
She's got it right there for you.
here's last year.
Awesome. Okay, thank you.
This is.
Some people that are also
This year.
exempt
But I
from
wanted to show
self-employment
you-
tax, children under the age 18 working for their father or their mother, they might, on paper, qualify for self-employment tax. They might have a filing requirement because mom and dad paid them over $400,
And then I'll keep
but they're
this,
actually
and then
exempt
bring me the rest of it.
from self-employment tax. I'm looking at this thinking of our farmers' kids. Termination payments of former insurance, we're not worried about that. Individuals for a country with an international social security agreement. My Canadians are exempt. One of them is a real estate agent,
Oh, no.
I don't know.
and she actually does have a Schedule C on her tax return,
That I need.
but I don't have to figure schedule or self-employment tax for her. There's a little checkbox because of this rule right here. Canada and the United States have a reciprocal agreement on Social Security. And of course, in Canada, it's called social insurance. Same thing. She's paying into that system up there. So since she's paying into it up there, she doesn't have to pay taxes into it down here. She's exempt. And like I said, I use my kidney beans for
I'll see you
example.
later.
No, for
Have a good
instance,
holiday.
so.
Huh?
Different countries have different agreements. Most
Yep.
of the civilized nations that you can think of probably do have an agreement. You can look this up. It's a big long list. I couldn't think of a country that came to mind that actually wasn't on the list. Not owe self-employment tax if you are a member of a religious sect. You filled out a 4029.
Yes.
You're Amish people. They're not going to draw Social Security because that's against their religious beliefs. So they don't have to pay into it. Clergies and ministers who accepted a 4361, these are especially those ones that have taken a vow of poverty, but they don't have to per se. But, you know, think of your Catholic priest. When they retire, Catholic Church will take care of them. They don't have to pay into Social Security.
And you said you were gonna do. Yes, yes, yes.
And don't forget on
Is it
our
an equal
ministers
debit?
that they might receive a W-2 from the church for this, that, and the other thing of just regular church activities. But technically, if they go off-site, for instance, and perform a marriage and get paid for it, that's a Schedule C activity.
As long as this is still valid.
Because they didn't get paid by the church, they got paid by the couple. So that's Schedule C income.
Do you have?
You don't see a lot of
deposits
ministers,
into it?
very rarely. I mean, we see one every once in a while. All right,
But I don't know.
so we
You would
are,
have to contact the card and get the routing and account.
worried about my mouse.
So if you know.
I forgot to plug it in the past couple of days and I forgot to turn it off.
That's how you can do that. I just.
So I'm just trying to hope that it works for about 15 more minutes.
And send.
All right, classwork. Chapter 11. Which IRS form is used by tax preparers to demonstrate compliance with due diligence requirements for certain tax credits? Didn't cover this in lecture yet. So you need an 8867. A single taxpayer may not reclaim a retirement savings contribution credit if their adjusted gross income exceeds a certain number. Now remember, we talked about this being a not very great credit. We talked about this being for more or less a working poor. So we can take that A answer and throw it out the window. The other three are pretty close to each other, so we'll just. What is a key component of the due diligence process for tax preparers? Again, since I didn't really cover this in lecture, but I have talked about this. Documenting methods used to determine eligibility for credits and deductions. Whatever we did, we make a note in our tax return in the software to say, this is how we got this information. This is the questions I asked. This is the things that I saw. Which credit is specifically designed to assist with the cost of higher education? Yeah.
Okay.
It was an interesting question. That wasn't even in this chapter.
I was like, is this a trick question? That's fine.
I can see that. That wasn't in this chapter. What is the main importance of conducting due diligence in tax preparation? It's to comply with legal standards and to avoid penalties. So technically, as a tax preparer, and you don't have to worry about it in our setting, because we will make sure you comply enough to avoid penalties through double check and stuff. If you do not, if you're deemed by the IRS as not have done due diligence, because they acknowledge the fact that you're not going to catch everything. There are great liars out there. Washington's full of them. So they know. You're not going to catch it all. You can't. It's not going to be expected. But did you try? Did you ask the right questions? So even if they got denied, if they look and see, well, they asked all the questions, the guy just lied to them, you know. They had no reason to believe that this was a lie. Yeah, you're off the hook. This is designed for people that are just trying to commit out-and-out fraud. And there are those tax preparers out there that do that. I mean, they go out and find a homeless bum. I'll pay you $100 right now if you let me file your tax return. They just put on all sorts of crap to maximize earned income credit, and then they have it come back to them, and they keep it. That's what the IRS is really trying to combat. Not only are you subject, and the fines are significant. I don't need to want to scare you, but it's over $560 per occurrence. Per occurrence. That's not just one thing on one tax return. It could be multiple things on multiple tax returns. Because occurrence number one is I didn't ask enough questions. And that filtered back to, well, occurrence number one, earned income credit. They had kids. Occurrence number two for not on the same tax return, child tax credit. Additional child tax credit. Already am up to $1,500 in fines. And that was just on that one tax return. I heard a horror story because I was watching a stream of our convention. It was last year. A guy came in and said his preparer was looking at over $50,000 in fines. We're not going to put you in that type of position. Like I said, all returns get double checked by somebody else. And if it doesn't make sense to us, it's not being transmitted until it makes sense. So you're never going to be in this position. Every time a tax return has gone out, we felt that there was enough documentation, enough was done to get you off the hook. When claiming the American Opportunity Credit, what form must be completed? Again, I can't believe that's on this chapter. It is A.
I kind of read that though.
It was, there was a slight mention of it.
Yeah.
When they showed the Schedule 3.
Yeah.
It was there, and I actually pointed it out. So, I mean, it was kind of in this chapter, but really, we talked about it yesterday. The adoption credit is an example of which type of benefit? It's a deduction, a non-refundable, refundable, or a payment. It's a non-refundable. Which of the following is not considered part of due diligence requirements for tax preparers?
Yeah, is that one in my routing number, account number?
Ignoring IRS notices that may affect the client's current tax year. I think that's kind of silly. I mean, I should still pay attention. I mean, I'm always looking at IRS stuff. I get an email from them every week. Things that they've deemed important for me to know as a tax preparer. The IRS does have an office in them for tax preparers.
I'm ready.
And that's what I was telling you guys yesterday about if something comes across the IRS website, videos, he'll post it on our Facebook page, on our employee Facebook page. So if you want to watch it, you can sign up and watch it. Or you're just curious or.
Well, and she was right. I mean, and she had most of the information she gave you right.
I'm ready.
So you don't want to take that test next year. You don't want to take
I
the,
explained that to them yesterday.
you need to participate in the AFSP program, which I have again qualified for. I took enough hours. Now, I'm a little bit different than what she is and what you guys would be because back in 2011, the IRS was actually trying to make it more professional for tax preparers. So you had to pass their test. Become a registered tax return preparer. I passed the test. I took it, I passed it, and then 2 weeks later, it was struck down by the courts. But the IRS says, hey, you did it. We're going to recognize the fact that you did it. So instead of, you guys need 18 hours, I only need 15. Now, of those 15 hours or 18 hours, 3 of those are ethics. 2 of those have to be federal tax updates. And Liberty provides those.
Yes.
You saw especially, if you go to the electives tab on there, you'll see the fact that there's a ethics presentation. It's the same one that's in the non one. I can't believe there's a difference. But it's worth 3 credit hours. And so you already got it. And then they also do the federal tax updates. That gets you 2. And then you can get yours, the rest of them, just by watching whatever interests you. Hey, you see a IRS webinar coming up? No.
I have to leave.
Okay,
Sorry.
faster.
Sorry.
Your
No,
client
I
received financial assistance from the government to help cover the cost of health insurance in the marketplace. To determine whether or not they're eligible for the tax credit, what form do I need? I need the 1095A.
Did have that needs to.
Makes me happy whenever I get
Well, why wouldn't it? Taxpayer may claim a tax credit for a prior year while under minimum tax. I didn't talk about AMT because it's too freaking messy. F, which is on the next page.
Okay, yeah.
I happened to look at and notice it earlier. It's like, well, that was stupid. Okay, so get the other one up here real quick.
Attention to the ages on your kids.
Yeah, I know.
I won't have time to staple it for you,
Well,
but
that's okay, yeah, that's fine. My daughter goes to work, and I thought we were getting out at 10, so I would not have.
I apologize.
No, I'm
I
fine, we're fine.
wouldn't be out here no later than noon.
Yeah.
Earlier would have been great, but I managed to get some things going ahead of time, so I saved myself just in case. All right, what qualifies as self-employment income? Wages received from an employer, dividends from investments, net earnings from a business you operate. interest received from a bank account. Pretty straightforward.
Your 16-year-old is getting ready to age out for a child tax credit.
Which IRS form is used by sole proprietors to report their business income and expenses?
So those are gonna make
Schedule C.
serious differences.
They should have put in a C, so that way.
Definitely
When calculating the home office deduction, which method does not require you to calculate your actual expenses? I mentioned this, but I don't know that I really hammered on what it's called. It's called the simplified method. I know I said it, but I don't know that I hammered it.
Let me ask you a question.
What is the maximum square footage that can be used to calculate the home office deduction using the simplified method? I actually did say that, but again, I didn't hammer it.
And if she is a dependent of yours.
I thought I
you
read
do
it.
that for her.
Now, there was a 600 number
So when I.
in the presentation, but it was 600 is the amount where if I contract somebody for labor, if I pay them over $600, I have to issue a 1099.
Yes, you can still claim her as a dependent.
8829 is used for calculating home
Because
office
she's not in
expense.
school, you don't qualify for her new pay credit.
Which line on Schedule C is used to report gross receipts for sales?
You qualify for
That's line 1.
the other dependent credit, which is-
Doesn't seem like it should be. It's halfway down the page.
Yeah.
Schedule F is used to report
Finish.
farming activities. F for farm, that makes sense. I don't know where C came from.
Cancel or whatever it is for.
Which of the following statements correctly describes how self-employment tax is calculated? Well, instead of reading all of those.
Unfortunately.
I didn't know that.
Well, yeah, I mean, you could have got it down to A or B. The rest of them, you know, these numbers, these numbers are off. And remember the 15.3, so you know those two are automatically wrong. You got it down to that. Which form is used alongside the Schedule C to calculate self-employment tax?
Go back.
The Schedule SC. And then really, they should also go ahead and say Schedule C and Schedule F, because if I'm on Schedule F, I'm a self-employed farmer, I pay self-employment tax.
Especially on this.
What is the purpose of completing an 8829 when filing taxes? To calculate the home office deduction. Which of the following is a non-deductible expense on Schedule C? Personal meals. I actually kind of mentioned that in passing.
So I'm here from 1 to 5 on Wednesday.
When using the actual expense method, so like for instance, I could have lunch
you want to,
just to put a quick hammer on it. But I can't write it off. Well, okay, I can't write it off anyway because I don't own the place. But if I own the place,
It's not gonna help.
if I bought myself Domino's, I can't write it off. If I bought Domino's for all of us, now I can write it off. So I could do that if I'm entertaining a guest or if I'm having a staff meeting. Either way, either one of those. When using the actual expense method for home office deduction, what types of expenses are considered? All of these. All right, I will see you next month, Wednesday.
Wait, is it Monday or
Wednesday.
Okay.
I don't know why I started saying Monday. It's
Either on
Wednesday.
Monday or Tuesday, Monday.
I did block out time out of the appointment book, and then I probably will try and contact Linda to see if she wants to come in
Okay.
and just
At
kind of
what
cover the
time?
office. If you be here at 9, it'd be great.
9,
I figured 9 would be okay with you.
Yeah, no, I'm good.
Yeah, I mean, if you want to show up, I don't care. But yeah, no, I've already done that for you. So that top page is out of order.
Oh, okay.
It fell out of the printer. It belongs in there
Well, that's okay.
somewhere.
It's 27.
It's the page number is there.
Yeah.
And you can tell that we reached volume 2 of the book because the page number is reset.
Okay.
Yeah.
Okay.
I noticed that, now I know why.
It's volume 2 if they actually printed the book.
Yeah. Well, thank you so much. I think you're an awesome.
I appreciate I appreciate it.
Happy anniversary.
Thank you. Thank you very much.
You're welcome. Bye.
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 The reason I'm asking is
My daughter got
Uh-oh.
it. And then she goes, are you busy? I said, well, but, okay,
Did I say
bye.
that right?
Really?
Well, at least you paid
She's in
attention.
Wisconsin. So how do you, they're in like freezing points right now. They're on minus.
They have nothing better to do except call people on the phone.
Little brat. Can't even tell me why. Give me a heads up why you're.
No,
Well,
Call her
have a
back
good
then.
anniversary night.
I'm going to work on it.
Stephanie,
She has a cold, so it's already kind of a bummer.
Oh, no.
Yeah.
Well, that,
scholarships or friends.
That's okay. I'm gonna liquor her up so she won't notice.
bye, Tina.
See ya.
Bye.
No, have a good Christmas. If I don't see you before.
All right.